In multifamily real estate, the property-centric philosophy versus the portfolio-centric philosophy is one of the major hindrances to becoming a realpreneur and being someone who's able to build up a big portfolio of multifamily investments. Listen closely today as I'll determine what is the difference between the property approach and the portfolio approach. A point in time where every real estate investor, landlord, or realpreneur has to transition from a property-specific or property-centric philosophy to a portfolio philosophy, where you're thinking a lot more about the ensemble of the portfolio that you have, the number of properties that you have, rather than looking at each property in a unique and siloed way, okay? So the way this happens is when you buy your first 1, 2, 3, 4 properties, obviously you're looking at all the metrics, you're looking at the price, you're looking at the cash flow, you're looking at the IRR on the property, and you're looking at it in a silo because obviously you don't have that many properties. But eventually, once you start to hit 4, 5, 6 properties, and maybe even before at 2 and 3 properties, what you want to start doing is taking a portfolio approach. Now, what this does is this allows you to eventually take risks that you wouldn't be able to take if you were only looking at each property separately. And obviously, the more risks you take, especially calculated and well-managed risks, the more you'll be able to increase your return on investment, the more you'll be able to increase your net value, and therefore eventually attain your objectives with regards to cash flow and to net value. This will allow you to possibly jump into acquisitions that might not make all the sense that it would need to if you were only looking at that one property, but because of the portfolio that you have, it eventually makes sense, or you can make the things work. So the best example is this: if you already own 5 or 6 properties and your debt service ratio for the whole portfolio is 1.6 or 1.7, and your loan to value ratio is around a conservative 55 to 65, 68%, well, you might have the opportunity to eventually buy a property that has a lot of hidden intrinsic value, but at the moment of acquisition is in fact very expensive and is going to have to necessitate a very high loan to value ratio with a very low debt to service ratio, meaning that, the property just won't be cash flowing and you're going to have to put a really big down payment into purchasing that property. Now, if you have a portfolio approach and you already have a portfolio of properties, you will have a lot more power to negotiate and acquire that property versus the realpreneur or the investor who only has 1 property or 2, or this is the first property they're buying, because they're limited by the metrics of that property, whereas you can, with a portfolio approach, aggregate those metrics into the metrics of the whole portfolio that you already have. Now, this will definitely help you eventually increase the value of your portfolio and the cash flows. Another thing when you have a portfolio approach is that you can start to manage risk by doing things like making sure that you're separating the timing of your refis. So obviously you have to refinance many of the mortgages on your properties. Now, if you own 8 properties and every one of those 8 properties must be refinanced at, say, year 5, well, that's a big risk management problem, because who knows where the interest rates will be during that year, and if the interest rates actually go in the wrong direction, well, then you're going to be stuck refinancing 8 properties with a pretty bad interest rate and with a pretty bad deal. You won't have any leverage with regards to your mortgages. So one of the things that you want to do is to actually start spreading out the timing of your refinances, and that's a great way to, number one, manage risk in case interest rates rise, but it's also another way to make sure that you're maximizing the accessibility to increased liquidity in case interest rates eventually lower and decrease. So by having that portfolio management way of doing things with your interest rates, you're actually giving yourself a lot more ammunition to be able to grow your portfolio in a very safe and risk-managed manner. I'd say that the other thing obviously is modulating debt service ratio and loan to value ratios, kind of like I explained earlier with regards to playing with your debt service ratios on various properties. You might buy a property that has a debt service ratio that's at 1.10, or maybe even negative, so say at 0.90, and that's having a negative cash flow. But if your portfolio is at a 1.60, well, ultimately your portfolio is still going to be very positive cash flow wise, and there might be a short or midterm reason why you'd pay that much money for a property even though it's cash flowing negatively. If you have a portfolio vision and strategy and philosophy, well, then you're going to be able to bank off of that opportunity, whereas you wouldn't be if you didn't have that philosophy. And I'd say that the final thing, the final point that you want to look at is diversifying the type of properties that you own. Now, if you already own 5 C-class properties and D-class properties in rough neighborhoods and Section 8 properties, you might actually want to buy your next property in a better neighborhood or a higher quality neighborhood with higher rents, less risk, less energy involved in collecting those rents and managing that property and managing that asset. Yes, that property might have a lower debt service ratio and might not be cash flowing as much as your C and D properties, but it's also a great way to hedge your portfolio and hedge your risk and make sure that, okay, you're smoothing out the returns that you have. Because eventually any realpreneur and real estate investor, you're gonna transition from wanting a lot of annual cash flow and huge cash on cash returns for maybe lower cash on cash returns, lower IRRs, because you are now putting more value on your time and energy and the stress and the probabilities of collecting your rent. Because ultimately, when it comes to building a portfolio, building a real estate investment company, you have to understand that it's a moving target. And initially, obviously, you want higher cash flows, you're willing to take on more risk, but eventually as you grow as an investor and a realpreneur, your objectives might change, the metrics might change, and what you're willing to accept with regards to returns might also change. Therefore, you have to be very conscious with regards to managing the ensemble of your portfolio and not always looking just at each property in an individual and siloed way. Thank you once again for taking the time to listening to Realpreneur Principles. If you have any suggestions or discussions that you would like to have in the future episodes, please go and write them in the comments of our YouTube and Facebook pages. And until then, make sure that you keep on applying consistently what you have learned here in the Realpreneur Principles.